escalating costs from material and labor are some of the factors behind this market stall.
Timing-wise, we're very, very fortunate. What it allows us to do is really take our time and see where our money will get us.
It's the first time since January 2021 that the average selling price was less than $1 million.
We could lose 100,000 jobs. Our sector in total employs 225,000 people directly and indirectly, so that would be a rather significant reduction.
Canada's housing market is spiraling into chaos, and the crisis is getting totally out of control. Prices are cracking, buyers are vanishing, and the system that once looked unstoppable is now showing dangerous fractures.
What's unfolding right now is a massive housing shock that could reshape the entire country. And this is where things start getting really uncomfortable for Canada's housing market.
Well, the average selling price of a home in Toronto was less than $1 million last month. The Toronto Regional Real Estate Board says more than 3,000 homes were sold in January at an average price of just over $973,000.
For years, I kept hearing the same story repeated again and again. Canada supposedly had one of the safest housing markets in the world. Prices always went up. Demand never seemed to slow down. Investors treated homes like guaranteed money machines.
Unfortunately, the cost of actually owning the property almost remains the same when you look at the interest rates then versus the interest rates today. But the number one question that I am getting in my business from buyers and sellers is, when are things going to bottom out?
That narrative became so powerful that a lot of people stopped questioning it entirely.
The assumption was simple. If you bought property in Canada, time would do the rest. But when you start looking at the numbers today, that story suddenly looks very different.
Our research showed it was the single biggest drag on housing activity. The interest rates moved from being a barrier to entry to being either neutral or even supportive. Employment was stronger than we anticipated.
Across the country, housing activity has slowed down sharply. National home sales have dropped more than 10% compared to last year.
Economic challenges facing Canadians, and while the softening real estate market is good news for first-time home buyers, the declining housing starts in a country that needs more inventory could mean problems down the road.
Now, that may not sound dramatic at first glance, but in a housing system that relied heavily on constant demand, losing that many buyers is a serious shift. Housing markets depend on momentum. Once that momentum fades, everything begins to slow. What really caught my attention, though, is what's happening to real value. The average home price in Canada is still hovering around $690,000, which might sound stable on the surface, but once inflation is taken into account, homeowners are quietly losing roughly 6 to 7% of real value every single year. The association says elevated supply will likely lead to lower average selling prices in the first half of 2026, though prices could stabilize in the latter half of the year if consumer confidence improves. That kind of erosion doesn't explode into headlines. It happens slowly, almost silently, but over time it chips away at your wealth in a very real way. So, the benchmark price down about $2,700 since last month, down $135,000 since last year. Back when Trev told us that it was interest rates that were keeping home buyers out of the market. As a reminder, that's also when CTV let Peggy Hill tell us that sales were down in November because November has fewer days and it snowed. That's why this doesn't feel like a normal housing slowdown. Something deeper is happening. Canada's housing market didn't suddenly crash. Instead, it feels like the entire system froze. Transactions slowed down, buyers stepped back, and the confidence that once powered the market began fading. And when I started looking closer at where the pressure is building, one city stood out immediately, Toronto. Several factors that are spelling out a slower market for the next several years. While new condo construction is expected to remain high in Montreal, the CHC predicts a dismal condo market in both Vancouver and Toronto. Toronto isn't just another housing market in Canada. In many ways, it drives the entire system. Investors across the country watch Toronto before deciding where to put their money. Developers plan projects based on Toronto price trends. Even lenders rely heavily on Toronto data when they measure risk, so when activity slows down, the ripple effects travel across the country. A seller of a new build, you're looking at a full deposit forfeit. Daniel Zadigan is a realtor who says sellers are losing deposits and then some when trying to sell condos they bought pre-construction 4 or 5 years ago when prices were high and interest rates were low. But he says the oversupply won't last forever. Right now, Toronto's benchmark home price sits around $938,800. That's roughly $135,000 lower than it was just a year ago. For a market that spent years climbing relentlessly, that's a serious drop. The general climate environment of uncertainty that has been brought about by the trade tensions and the uncertainty going forward has definitely impacted housing investment. And once investors and lenders start seeing weakness in Toronto, caution spreads quickly. Capital tightens, lending becomes stricter. Suddenly, the entire housing system begins to feel the pressure. But the real shock isn't just prices, it's what's happening to sales. We've seen much greater growth in listings than in the past, and we've also seen sales drop off. So what that means is for people who have been active in the marketplace, they've had more negotiating power. And so we have seen selling prices trend lower. In February, Toronto recorded just 3,268 home sales. That's the lowest February level since at least 2014. For one of the largest housing markets in North America, that number is extremely quiet. When you compare it to the long-term trends, sales are running about 30% below the historical average. That means thousands of buyers who would normally be active simply aren't participating right now. And here's the part that makes the situation even more concerning. There's no question that the developer will chase you through the courts, and they will win because you signed a valid contract. There are more than 22,000 condos forecast to be completed this year in the Greater Toronto Area. Experts predict up to 35% of buyers could default. Borrowing costs have already started easing from the peak of interest rate hikes. Normally, when mortgage rates fall, buyers return quickly. Lower borrowing costs usually reignite demand almost overnight, but this time that rebound isn't happening. A scan of Toronto's skyline shows how much has changed. After decades of growth, now only one crane can be seen. In December of 2025, the number of new home sales was 240. That's down 24% from 2024 and a whopping 82% from the 10-year average. Buyers are still hesitant. People are still waiting. And when that behavior spreads across the market, it signals something deeper than affordability problems. It signals a confidence problem. I would say the market right now is resetting. It's just not collapsing. People aren't just asking whether they can afford a home. They're asking whether buying right now might actually be a bad decision. That's a massive psychological shift. At the same time, the media has been pushing a very different narrative. Our research showed it was that the single biggest drag on housing activity. The interest rates moved from being a barrier to entry to being either neutral or even supportive. But when I looked deeper into the numbers, the situation appeared far less extreme. The long-term average for February new listings in Toronto is about 11,176 homes. This year, roughly 10,750 properties were listed. That's only about 4% below the historical average. In other words, listings are still fairly normal. Obviously, there's concern around our trade relationship with the United States. There's other geopolitical issues that are feeding into that uncertainty as well. The real issue isn't sellers disappearing, it's buyers disappearing. Listings are close to normal levels, but sales are far below normal. That's why the market feels heavy. Homes are still coming into the market, but far fewer buyers are stepping forward to absorb them, and that imbalance is starting to show up in the inventory numbers. Timing-wise, we're very, very fortunate. What it allows us to do is really take our time and see where our money will get us. Toronto currently has around 19,134 active listings sitting on the market. That's one of the highest levels heading into the spring season since 2014. Inventory has been quietly building while demand continues to weaken. A buyer's market, especially for anyone looking for their first house, but for those selling, it means more days on the market, lower prices, and experts expect this trend to continue. Another metric makes the picture even clearer: months of inventory, which measures how long it would take to sell all available homes at the current pace, is now sitting around 5 months. That's the highest level entering the spring market in more than a decade. Simply put, there are far more homes available relative to the number of buyers, and that shift is already changing how homes sell. Properties in Toronto are now closing for roughly 3% below their asking price. During the pandemic boom, that would have sounded almost impossible. Back then, bidding wars pushed homes far above asking prices within days. Now, many homes that once sold instantly are sitting on the market for weeks. That's a huge psychological shift for both sides. Sellers are realizing the frenzy is gone. Buyers are realizing that they finally have time to negotiate. Recent data from the Toronto Regional Real Estate Board shows the average condo selling price in the GTA was down by 5.1% year over year in the fourth quarter of 2025. In one Toronto neighborhood, the average listing price for that period was just under $385,000. For the city of Toronto as a whole, the average price was around $690,000 during that period, down from about $715,000 the year before. So, let's talk about the part of the housing market that usually moves first when things begin to go wrong, and that's condos. Condos have always been the easiest entry point into the housing market. First-time buyers step into the market here, and investors often park their money in these units. The strategy always seemed pretty straightforward: buy a condo at a lower price, collect rent, sell later when the market rises. For years, that strategy almost looked foolproof. TREB predicts slow sales and price weakness to persist at least for the first half of 2026, which comes on the heels of a dismal 2025, which saw the lowest number of home sales in 25 years. But right now, the condo market looks like someone pressed pause and forgot to press play again. In the Greater Toronto Area, new condo sales dropped to just 316 units in the third quarter of 2025. Now, that's a 35-year low. Sales are 54% lower than the year before and about 92% below the 10-year average. That's not a mild slowdown. That's an extreme collapse in demand. At the same time, something unusual is happening on the supply side. Brand new condos are sitting empty. Toronto is not alone, with other major markets seeing home sales slide last month as well. In Vancouver, sales were down nearly 30%, Calgary nearly 15%, and Edmonton down 27.6% compared to the year before. In Metro Vancouver alone, roughly 2,500 newly built condos currently have no occupants. These are not aging units needing repairs. They are brand new buildings with modern kitchens, fresh interiors, and new elevators, yet many of them are still sitting empty. Even more surprising, that number has doubled compared to last year. This matters because developers don't build towers hoping buyers eventually show up. The entire industry relies on pre-sales. Before construction even begins, developers sell a large portion of units to investors. Those early purchases help prove demand to banks, which allows developers to secure financing for construction. But lately, those pre-sales have been slowing down significantly. When buyers disappear at that stage, developers start pulling back. Meanwhile, another wave of supply is already on the way. Lower prices are obviously great for buyers, especially renters who are trying to get into the market, but some real estate experts say this could lead to a housing shortage in a few years. We've heard stories about low pre-construction sales. Eventually, that's going to translate into fewer starts and fewer completions down the road. One of the things we need to look at from a policy perspective is how we are ultimately going to fill that gap. In the Greater Toronto Area alone, around 26,000 condo units are scheduled to be completed within the next 18 months. Most of those projects were launched during the pandemic housing boom, when investors were flipping pre-construction units rapidly. Back then, the strategy seemed easy. Buy early, wait for construction to finish, and sell the unit before even moving in. But the market those investors expected no longer exists. Now, many of them are discovering something uncomfortable. The units they agreed to purchase years ago might actually be worth less than what they paid. At the same time, borrowing costs are higher and mortgage payments are significantly larger. People are struggling. We have doctors and surgeons, pharmacists making a couple of $100,000 a year who are struggling to survive. A lot of doctors' offices have shut down because things are too expensive. The rents are too expensive. We need some serious change. What once looked like an easy investment is starting to feel like a monthly financial burden, and that leads directly to another pressure point, the rental market. For years, rising rents helped keep the condo investment model alive. Even if mortgage payments were high, landlords could rely on rent increases to offset the cost, but that support is starting to weaken. In Toronto, the average one-bedroom rent now sits around $2,200. That's roughly $400 lower than the peak reached in 2023. Year-over-year rents have fallen about 6% in the city. Vancouver rents have also dropped more than 4%. When rents fall, while mortgage costs remain elevated, the investment math changes quickly. And then there's another major event approaching, the 2026 mortgage reset. Nearly one-third of Canadian mortgages will reset that year, exactly 5 years after the ultra-low interest rates of 2021. Back then, some homeowners locked in mortgage rates around 1 to 2%. Those borrowing costs were incredibly cheap. When those loans reset, monthly payments could increase dramatically. Even if interest rates don't rise further, the gap between pandemic-era rates and current borrowing costs could still create significant payment shocks. The impact for workers has already begun, with predictions of much worse to come. It raises the big question now hanging over Canada's housing system. Is this a temporary slowdown, or is the country entering a much longer period of housing stagnation?